I think we're broadcasting, right? Okay. Hello. Thank you so much for joining us tonight. Welcome to the Money 101 workshop with the Assisterhood program. First of all, let me say thank you for making the time to jump onto this workshop because it's such an important topic. But before I run into the topic itself, I'm going to make a couple of things really clear. You'll be seeing me from a slightly weird angle down here because we actually are hosting this event in real life and we're streaming it to you guys tonight live. But there is an audience here that you may hear in the background softly. So before I jump in, I am going to talk really quickly about the Assisterhood program itself. Right. Oh, let me run through the agenda for this evening. So, welcome, which I've just done. We'll talk about the Assisterhood program really quickly, what other workshops we have in the pipeline. So this is the first one. The actual workshop itself is what you're here for tonight, and then that was a Q&A, and then finish for the evening. So, let me tell you about the logistics, the boring stuff first. So, there is a Q&A function in the chat, so on the webinar itself. If you have any questions, please drop them in there. Guys, in real life, please hold your questions, write them down, and we'll answer all of them at the end. We're going to run through the presentation straight through and then answer all the questions again because I know there's going to be a lot of questions naturally, and we just want to keep the flow going for the presentation itself. The Q&A, like I mentioned, is at the end of the presentation, and there will also be a webinar recording after this because then you can watch it again and again and again because there's going to be a lot of gold in this presentation tonight. That's the boring but important bits. Let me get into the Assisterhood program itself really quickly. If you guys don't know, the Assisterhood is a mentorship program that connects young females and communication professionals in the industry with senior leaders. In our in real life event here tonight, we have some of our mentees from this year's program, and we also have past mentees, past and present. So yeah, we're all about connecting people and empowering people to be the best versions of themselves. And what we're trying to do this year, because this year was the biggest year we had for the Assisterhood program, we had 150 applications and we only had 21 mentors, I should say. That we were able to pair people up with. And so because of that, we realized we had to say no to 129 odd people, which is, for me, such a devastating blow because it's 129 people put their heart and soul into an application and we had to turn them down. So what we've decided to do this year is employ an amazing Assisterhood team and basically do more with the Assisterhood program. And the analogy that I like to use for that is, I guess with the mentorship program, you're kind of showing that you're bringing people up a ladder one at a time. But what we like to do now is cast a net and to see how many people we can scoop up as much as we can. So that's what we're trying to do with the Assisterhood program itself. This is a workshop series, and this is the, you guys can see that we have workshop 1 obviously here tonight with Money 101, but I'm really, really stoked and excited to say that we have workshop number 2 locked in and loaded, and we have none other than industry legend Kat Maxson hosting our workshop number 2. And as I mentioned, she's a superstar. I remember my first event with her where she was facilitating, and I just remember thinking, oh my God, she's a rock star. I want to be her. And that's what the Assisterhood program is all about. So we have asked her to host our second workshop, which will be in 3 weeks, and registrations will open for that tomorrow. So keep an eye on our socials. But tonight is all about Money 101. So setting yourself up for financial freedom. We think it's a really important topic. It's something that we all use, money. It's all something that's a really important part of our lives and our livelihoods. And I went through this journey myself and thought, you know, I actually don't know what I'm doing with my super. I'm in a lot of debt. I know that I should be doing something with my savings, but I don't really know more about it. And so I thought, you know what? I'm going to go see a financial planner and see what she has to say about all of this. And I met Tamara, who is going to be our speaker for this evening. And she has opened my eyes to so much about money. And I can't wait for her to share those same learnings with you this evening. So without any further ado, I'm going to invite Tamara to join the stage. And she's going to run through the presentation, and you are going to be writing so many notes tonight, guys, like pages and pages. Save them all down. If you don't get everything this evening, there will be the webinar recording afterwards. And I can say that Tamara's also got an ebook that's coming out. It's almost finished, and we'll be sending that out to you guys that are registered here tonight as well. So here we go. Thank you.
Hi everyone, thank you so much, Lynn. You can really probably imagine why I love what I do, to get to work with people, you know, like Lynn, motivated people that really want to make a change with their finances. So I'm really excited to be here. When I heard about the Assisterhood, I was just blown away. I didn't know anything like this existed, and I wish it did when I was in my early career as well, because I didn't belong to anything like this. So yeah, really excited to present tonight. And I almost wish that we had done Kat's how to present first, because I could have made things better. Oh, geez, so next time we can do that. So I'll give my best shot, and it might, instead of Money 101, it might be 301, because some of the strategies might get a little in depth. But again, I've got, as Lynn said, I'll make sure that when the ebook comes out, you guys get a free copy through Lynn and Claire and the team as well. Just give me a couple of weeks to polish that one as well. So let's get started on the Money 101, which I've called the 8 steps to financial freedom, because it is steps, and steps help you actually know where to start. So this is the reason. And as you can see, I'm Tamara, but I have to legally mention the disclaimer, which is this is a presentation which is general in nature. So you've got to seek personal advice and make decisions that are right for you. This is a general overview. So this presentation here is for those, that are wealth accumulators, which are 20s, 30s, and 40s. So these are the strategies that suit kind of this age group and different experiences that we need. And for those who want freedom and choices and that want to be proactive with their money, we'll talk about goal setting, investing strategies, super. How does it look like getting advice, and just then I'll give you some examples as well. And again, there's a bit about the ebook that's nearly there as well. So just a brief intro about me. So I'm a certified financial planner. In 2014, I started my own company just because I wanted advice to be more accessible and modern, and to help a wide variety of clients, not just solely retirement clients, which has been typical for financial planning. And so my company is True Journey Financial Planning. And on a personal note, I'm a bit of a foodie and like croissants and chocolate and stuff. So that's just me personally. That's about it. I used to do gym, but now. Again, on a personal note, the reason I love what I do, which can get a bit technical, a lot of numbers, I was, kind of naturally born into this profession because when I was really little, my mum went through a divorce. She wasn't left with very much, but I saw her really stand up on her own 2 feet, and she opened up her own shop. She had to work really hard, educate herself, do her own budgeting, negotiating contracts, and I was always there with her. I used to handwrite my own checks to go and cash and to get my pocket money. But I learned from a really young age is that it's not an option to just stick your head in the sand and think that money will just happen. I learned that you have to control money or it will control you. And you can't rely on a Prince Charming to come. You've just got to really do it yourself and learn. So I didn't know any different. So all through school, I'd always just been very organised and aware and knowing what I needed to do with my own finances. And then that's why I love sharing this as well, because it's just instilled in me from that. In particular, women need, we do start from behind. The statistic and the fact is that women retire with 50% as less super as men. That's due to the gender pay gap, over the years, but also due to, women are more likely to take time out of work or part-time work, helping family as well. So that's something to be aware of. Many of you do have to be aware of that and work harder for that. Again, that's a really sad statistic, which is only a few years old, that women are now the fastest group of homeless people, those approaching retirement at 55. And actually, even now as financial advisors, only 20% of us are women. I know when I go to conferences, there's not that many other women to talk to, and that's, not really helping the situation. So I'll try to share my knowledge as much as I can. And actually now, with everything that's going on, it's still a really good time to start paying attention to your finances and make plans as well, because there are opportunities which I'll show you today. With COVID, there is some financial uncertainty. We can't ignore that. People their incomes have dropped. Nobody's traveling at the moment much, and some industries are much slower. So, it's something to be aware of. But on the good side, it has created some opportunities because the government is stimulating the economy. Like, this is $200 billion. It's the biggest stimulus package we've ever seen as a nation. And lower interest rates, which can help people who are trying to build wealth as well. Historically low interest rates. And that's also lower share prices, so it's cheaper to buy to get a parcel of shares, a portfolio, even a home. And then you've got the grants, building grants, first homeowner grants. So there's a lot of opportunity, and for people in their 20s, 30s and 40s, you've got time to really make it work. So that's what I want to show you guys as well. But the thing is, I understand that with money, it's hard to know where to start. With opportunities comes some confusion and questions. So it's natural to know, to ask yourself, is it a good time to start investing, and even how can I do it? How do I make the most of opportunities? How's my super going compared with others? Is it good enough? And even some people can have frustration if they spend a while in uni or part-time and think, well, gee, I wish I was further ahead. So these are all things that I'll walk you through in the presentation now. So we'll get stuck into it now. And so these are the 8 steps which we'll go through each one. And they are getting clear on your dream life, setting smart goals, savings, investing, getting a strong super fund, then protecting your lifestyle, and then debt management, and then having how to surround yourself with good people and get your dream team. So the first one is to get clear on your dream life. So it's really about asking yourself what you value as a person. Do you want to spend your time with family, traveling? Do you want to be in your dream home? Once you really dig deep and understand where your values lie, this is really important because it then keeps you more focused, makes savings easier, but it then allows you to go to the next step, which is number 2, which is setting smart goals. So again, you've got to understand what you really want, what are you trying to achieve in your life, because then you can set smart goals. And the SMART goal, you may have heard the term before, it's not unique to finance. It's just about having a goal that can be measured and it's specific and it has a time base, but it's also realistic and achievable as well. So here are some examples of SMART goals, right? So holiday to Fiji, it's specific, it has a value, and you've got a time frame. And the whole point of this is that this will keep you more accountable to yourself and keep you focused, because a lot of people, when I meet them, they say, well, I haven't been saving because I just didn't have anything to save towards, so I didn't really see the point. So whether it be, even repaying debt, again, that's the top one here, that's the most important as well. So that's an example of your SMART goals. As well, use imagery. That's so important as well. Put some photos around your goals so that it's always front of mind, and that will seep into your decision making as well daily. So that's another tip as well. So that brings us now to step 3, which is getting to save. So we can't reach those goals if we don't have any savings. It's not that easy because a quarter of us don't save, but you should be trying to aim to save around 10 to 15% of your salary at least each year. And by doing that, you're essentially paying yourself first. Before your bills, you're paying yourself in your future. And definitely try to save bonuses and windfalls and promotions and tax returns and things like that. That's just extra money to save. So the way to make savings easier to start with is to set up a bit of a budget. The way to do a budget in the easiest way really is to firstly start with writing down your essential costs, which is things that, when you wake up, costs that are going to happen regardless, things that are essential, like your phone bill, transport to work, food, groceries, and things like that. So once you list your essentials, then you can write down the non-essentials. So these are things that if times are really tough, that you could cut out. So things like subscriptions and entertainment and drinks and things like that. So the whole point of separating these two is that when you look at your non-essential costs, you can start to think, well, what's not serving me? What aren't I really getting value from? What am I not using? And then that's where you should start to save. And so cut those out. If you miss them, you can bring them back in, but just cut them. I promise you probably won't even notice it. You'll enjoy simplifying your life with those. So once you've done that and you can then recognize the savings, then what we want to do is, now we know the savings amount that you want to strive for, let's start using automation. We'll use automation as your own personal assistant. So what this means is, you have a transaction account because that's where your salary goes into. So have money go into your transaction account, but that savings amount, move it away from that account automatically via a direct debit when your pay hits. Move it to its own separate account and don't have a card on that account. Don't make it easy for you. Send it to another bank if you have to, because the whole point of this is that we're only human, right? And if we see money, it can be more easily spent. So it's best to physically separate yourself from your savings. And it's just that extra bit of friction to get your savings, which will really work. And then as your savings ability grows, you can start to do this, have multiple accounts for multiple goals. And it's so rewarding seeing those grow as well. So again, it's about using automation and having it as a default that you're saving automatically. That's about long-term wealth creation. That's one of the main things, is consistency. And as well, with technology now, it's more easier than ever. So you can have a look at these types of softwares as well. So Pocketbook is one for an example. So I'm not affiliated with these. They're just pretty cool things that help make it easier. The way it works is it syncs to your bank account. It gives you clarity because you can then categorize your expenses. And it's, probably going to be a bit more fun than an average Excel spreadsheet if you like to have that extra clarity as well. So there's a bit of an example. So check those out. It does give you more clarity over time. So now that we know we've gone through these steps and that you know that you actually can save and you've got the savings ability, the question naturally now is, well, what do I do with these savings? So the number one thing you've always got to do first is to firstly pay off any expensive debt. So expensive debt is personal consumer debt, such as credit card. Their credit cards are often above 15%, that's expensive debt, and even car loans as well. That will always be the first thing. Pay these off, because then you'll be paying less in interest costs, which will then allow you to save more. So it's a positive snowball effect. And then when you get close to reducing the debt, just reduce the limit as well. Then once you've paid off all your expensive debt, the next step is to create an emergency fund. So you may have heard about this, but it's so important to save at least, say, 2 or 3 months in an emergency cash account, because the purpose of this means that then if something happened and you needed money, you're not going to reach for the credit card and then go back and have expensive debt again. So that's really what it's there for. And it gives you a good feeling of abundance as well, just to know that, you've achieved that and you've got that money sitting there. So those are the steps there. So now I want to talk about step 4, which is, what I love, and it's really interesting as well, is investing. But you do have to complete those steps 4. You can't invest, say, if you've got credit card debt or if you haven't built an emergency fund. So the thing about investing, the reason investing is so important is that if you just put all your savings in the bank, you're going to be lucky to get 1% for them. And this is because we've got historical low interest rates. So you've got to really, our generation of accumulating wealth, you've got to really understand these low interest rates are not going to do us any favors over the long term. So investing is a way to reach your goals and bring them forward and reach them sooner. And that's really the important reason for it. But again, investing brings up questions, right? There's a lot of misconceptions about investing. People think they'll lose money, or that they don't have enough to start, that you need a lot of money to start, which is not true, or that they procrastinate and say, I'll do that later, or that, of course, not understanding, that's also a reason to not invest. But that's when, professionals are here to help and explain options as well. So I want to make sure that I bust some of those myths to give everybody a bit more confidence to understand investing. So I'll go through a bit more about investing. So with regards to the types of things that you can invest in, so you can see here you've got defensive assets, which is what I mentioned about, say, leaving money in the bank, cash, or fixed interest, which is a term deposit. So those are the options, again, not paying much in the long term at all, but you have the stability. If we look at other options as you start building savings, you've got growth assets, which, property, that's a growth asset. Over time that's performed better than cash, and same with shares. So when I mean shares, I'm talking about the top largest companies in Australia. You've got Telstra and Coles and Woolworths and the banks and the blue chip classic shares that have also grown well. So when we talk about the growth assets, it is correct that in the short term, they do experience ups and downs. The price does change daily. This image here is pretty much what it looks like. There are ups and downs, but it's worth holding the course, because that's why investing is only for the long term, say, over 4 years plus, because it wouldn't make sense to invest and then 3 months later, if there's a dip in the market, pull the money out. You have to stay the course and understand there will be volatility. But it's worth it to do this, because this slide, for example, I know there's plenty of numbers here, but if you look at the green selected column, these are the returns over the last 30 years. So cash down the bottom, say 5%, that was in high interest rates. And then you've got Australian shares and property, all that have historically performed over 9%. But again, to get those averages, you've got to hold the course, because each year it will be different, but that's an average annual return over the last 30 years. So that's very interesting as well. We don't know in the future, but again, they're still called growth assets for that reason. And if it's a tricky time in the economy, like if you're thinking, oh, well, I can't invest now, it's, there's uncertainty and the market's low, you've got to think of, when the share market is at a lower price and property prices are low, just think of it as though they're on sale, right? So, we used to buy other things on sale. So until recently, just think of it like bananas, for example. Until recently, bananas were $3 a kilo. So now they're 30% off at $2 a kilo. Same banana, same taste, same nutrients. So now they're cheaper. It's time to stock up. So that's how you really got to think of assets as well. And so here are some tips about investing even further. So, the earlier that you can start investing, the better it is, because then you'll have more time on your side, and then you start getting the benefits of compounding interest as well. And you can start small. You can start with as little as $1,000. You don't need to have, tens of thousands of dollars to start investing. And invest regularly. So again, we want consistent buying into the market at different points in time. Then of course, reinvest the returns, because growth assets provide income, rent, dividends, reinvest them, use that money to buy more of the same where that came from. And then of course, get a plan and stick to it, because again, we're human. If there's a dip, people may sell investments, but if you know where the plan's heading, you'll be more likely to stick to it and get better outcomes as well. And then a really important thing to reduce risk is to keep your investments diversified. That's the #1 way to invest safely. So now I'm going to give you an example of how all of this ties together into a type of investment option, because again, that's answering the question, well, where do I start? This is one thing you could consider with advice, of course. So it's called a managed fund. So the way that a managed fund works is that it pools everybody's money together. You don't need much to invest in a managed fund. It brings everybody's money together and then spreads that money out over different asset classes, such as some in international shares, some in Australian shares, some in property, and we tweak the numbers as well depending on people's goals. There are managed funds that specialise in healthcare, some in technology, and then we can blend them all together, and you can hold more than one managed fund as well. So this is just an example of a way to start investing. You can pay into them, withdraw if you need. So again, it is accessible as well. So I want to just give you an example of a client who how we used managed funds in her particular situation, because there's a few money lessons involved in this case study as well. We can see how they can be used to further increase wealth and things. So again, this is this example here. So Sabrina has a home loan and she can save, and she really just wanted to know, well, she's got a good savings ability. Do I use this and just pay off my home loan, all of it onto the home loan? Or should I look at something else? You know, she'd heard about shares and things, people are talking about investing more in general. So she just wanted to know what was right for her now that she'd had a promotion and had that extra money now. So the way that we approached Sabrina's situation is just really look at the numbers. So first of all, again, due to low interest rates, we looked at the home loan and thought, well, that's only 3%. So technically, every time she's adding extra money onto that, it's only working for her at a rate of 3%. That's essentially her return on her savings, 3%. And then when we looked at the, the growth portfolio and what that, should be doing and how that's invested, then it would look to be a higher return over time. And again, it's a long-term strategy. And then we crunched the numbers further, like with all financial advice, we do projections. And then we saw again, this compounding effect over time. So if Sabrina was just to say, just pay off the home loan in 20 years, if she sold everything, this would be her net worth, so $745,000. Or if she had have done the diversified investment strategy and just kept her home loan at a minimum what was needed, then her wealth would be more by over $1 million. So again, it's a strategy that is very interesting as well, and it shows how we can use investing as well. I mean, in this particular example, a few things have to be at a certain level for it to be effective. For example, this strategy works if it's low cost debt. It's not going to work with a credit card that's say at 20%. So again, home loan, low cost debt. Of course, you've got to invest in something that should do more than the 3% home loan. So high growth investments that are diversified, and you've got to have the risk tolerance for this. For some people, it may be too much. So again, she had a growth mindset. And seek personal advice. So through education, you can start to understand and be more comfortable with these strategies as well. So now we've talked about how you can help yourself today, but we also really have to talk about your superannuation, because it's one of your largest assets over time, and this is what will be important to retire. And it's an area that I see a lot of room for improvement with as well. So I spend a lot of my time refixing up people's super when they haven't looked at it and getting it to work again. And this is why we should really care, because a third of our life is going to be spent in retirement, where people are living longer due to technology and healthcare. And that's a really long time, and that you have to fund that with your own money as well. So the reason you have to fund it is because we don't know if there'll be an age pension. All this money the government is spending, it really has to come from somewhere. And the age pension is something that could be affected. So again, you've got to be self-funded, can't rely on the government to really support you there. And if you really wanted to look further as well, which is interesting, if you thought the government could support you, this is the current age pension. It's really not much. Say 32,000 for a couple, 22 for a single, but even the Australian standard itself said a couple needs at least 62,000 in retirement to live what's called a comfortable lifestyle. So again, that's more reason why we have to support ourselves and understand the super. So the question is, I know it's a long way off retirement, but how much will you need your super to grow by? So again, here we've got to be able to produce enough money to give you 60,000 a year. This is what you'd need, say from age 65 onward. So you'd need to be retiring as a single person with over 500,000 and as a couple with over 600,000 as well. And I know it's a long time off, and you'd be surprised how well your super can grow if it's invested right and if you get contributions, because you've got the power of growth behind you, compounding interest. Another thing that super has going for it is really low tax rates. So super is basically Australia's tax haven. Here we go. 15% is the rate that super pays tax at. And even when you retire, then it pays zero tax. But your income can be taxed up to 47%. So the fact that super pays very little tax means that all your money that's in super has the ability to grow at a faster rate. So that's why, I'm really glad that people have superannuation and getting their contributions going into this tax haven. It will work much better for them. And then it gives you a tax-free income after age 60 as well. So there's good reasons. But again, we've got to think about, well, how is your super set up? A lot of people that I meet, they tell me the same thing. Oh, well, I got this from my payroll when I started my first job, or they may have multiple supers. Somebody else has often chosen it for them, or they've just had a quick check and invested what they thought was the best. So something to be aware of. So the way it works with super is if you yourself didn't actually make any decisions or any options, it's invested in what's called a default investment option. So every fund has this. For people that don't make any personalizations, they'll just invest you in a one-size-fits-all default option. And it's not right for everybody. Some have lower growth, some have higher growth. It really depends. Every super fund is different. Some are very low growth. Just here is an example as well of the ways that some super funds, how they position their default options. They're just trying to be a one-size-fits-all, make everybody happy approach, but it doesn't mean it is right for everybody. So it's definitely worth personalizing. And so you've got to ask yourself, look at your super fund, try to look at the investment option and see what percentage of growth actually is it. Is there large sums of just cash in it that may not be working? So it's really worth looking at. Say, for example, just to show you the long-term impact of different style of super fund, say one that's mostly cash-based or one that's mostly growth-focused based on Sabrina's details, 32 years old, her salary, say she had 80 grand in super, the difference of tweaking her super to be more growth-focused would allow her to retire with $200,000 more, and that's just by age 60. And that's the difference between someone working all the way up to maybe late 60s or being able to retire at 60. That couple of $100,000 there. So, it's because it's such a long time frame. Any tweaks that you make earlier gives you a huge outcome over time as well. So how to know which investment option is actually right for you, which fund is right for you? First of all, depends on age, like how long you have until retirement. Naturally, the longer that you have until retirement, the more growth focused you can be, because as I mentioned before, you can weather the ups and downs of the market. You may not even look at it, and your comfort level as well, and then how you're tracking as well, how much you need your super to grow and to catch up to where it should be. You want to look for a fund that has strong performance, that's transparent so you can see how your money's invested, that has competitive fees as well, and has a variety of investment options, because again, you want to have some choice about how your money's invested. And that's where we add value as professional advice as well. We like funds that have a lot of investment options, so we can put together a few together for more diversification as well. And so just in summary, here are the tips for getting good growth in super. So know your appetite for growth if you're growth focused or more conservative. Select the right options for you. Make extra contributions over time when you're in a position to do so, and then adjust the strategy over time. So when you get closer to retirement, you'll want to be a bit more conservative as well. So we've talked about growth and building wealth, and I definitely have to talk about protecting your lifestyle. This is hugely important. You've got to make sure with all of these strategies that you do have a safety net. So you've got to really think, well, all this is well and good, but if I couldn't work for a few years or ever again, what is my plan B? What is the safety net? In Australia, we're well known for having an underinsurance problem. So we all insure our things. So we have high rates of insurance on motor vehicle, home and contents and our buildings. But when it comes to our own personal insurance, which includes life cover, income protection and total permanent disablement cover, we have very low levels compared to other developed countries. And it doesn't really make sense, right? Because without your income, then you wouldn't have even been able to purchase the nice things and your contents and your car as well. So that's why it's actually more important that you've got to protect your income as well, and your ability to be comfortable in life if you couldn't earn an income. Again, we want to know, well, why is this so? Or why are the levels so low of personal insurance? Most of all, from my experience, people don't really realise it's just a number written somewhere on a super statement, because cover is mostly inbuilt into a super fund. So again, that can cause a misconception and people thinking, yeah, I've got enough in my super, where it's not often. Very rarely it's enough. As we saw from that chart. And then, of course, people will think, well, it won't happen to me, I'm young and healthy. People think I can't afford it. People overestimate the cost of insurance. It's cheaper than what people think and more affordable. And then, of course, there's that I'll get around to doing it or not quite knowing where to start. And again, coming back to the it won't happen to me, that's a common one. You know, Australians like, oh, she'll be right, we'll be fine. But, you know, we've got to really understand that, things do happen, especially because it's a long-term frame. We're trying to protect you all the way up to retirement. And there's a 1 in 5 chance that someone will claim on their insurance by the time they're 65. So, you know, just to put some statistics there, and even 1 in 3 can be off work. So, you know, even in my role, I deal with a lot of insurance claims, and it's just something that, you know, we've got to be protected for. And again, because not having the cover in place, it's not really nice to think about what your options would be. There aren't that many backup plans. And the key thing with insurance as well, I would get a call, you know, say once a month at least, for someone that's had a life-changing health scare, asking if they can get cover, and often by then they can't get cover. If there's something really significant on your health history, abnormal blood tests, or some doctors are concerned about something, then the insurers will shy away and decline cover. So it's vital to do it while you're younger and healthier, if you can do that. And I still have ways to insure people that have a troubled health history, but the options are not as good when when you have a cleaner health history, really, to be quite frank. So the earlier you do it, you've got to really put insurance in place while you don't need it. It's the same with a car, right? You can't insure a car that's, you know, that you're having trouble with. So, and the good news is as well, you don't have to worry about affordability issues, because it can be funded. They can get good quality cover at the right levels, set up in the right way. It can be funded by the super and still allow the super to grow. And I do projections on that as well. There are ways to see how the super will grow, even with insurance. And so if this is your preference to have the super fund your income protection, then it's possible as well. A lot of people may not quite realise that, and they're surprised to hear that. So this is another benefit here about, so this is a little bit technical, but it's really cool, and I really like this. It's really good to know. So this is an option that's good when you set your insurance up, and really with this, the younger the better as well. I couldn't talk about this strategy for clients already in their 50s, for example. So you have an option when you set up personal insurance, whether you opt for stepped premiums or level premiums. And not a lot of funds offer level. It's a little bit more complex, but just I want you to understand the concept of it. So stepped premiums increase with cost each birthday, because it makes sense, right? Each birthday you'll get older, more likely to claim as time goes on. Whereas level premiums, they lock it in at your current age. So you'll be basically paying a similar premium to now, even when you're 60, because it's calculated at your current age when you start the policy. So that's the difference. And I'll show you a chart on what it looks like as well. So this again is a projection of someone mid-30s, what each option looks like. And the chart is actually the cost of cover. So the black line here is a stepped premium, which increases with age. So you can see it gets really dear from, say, 40s onward, and the level premium here is more stable over time. So there are ways to blend them and do things, but it's just a good topic that I wanted to educate people on as well. So going back to an example of a real person, I calculated, so we'll go back to Sabrina's case, at her age, so early 30s, I calculated the options for her, and we looked at the affordability today, in the future, and looked at the total cost of cover. And in her case, we did we looked at the level premium here. So that's what we look at as well, the lifetime cost of cover, because you would keep insurance until you retire, or until you pay debts or inheritance, or some trigger meaning that you're financially stable. So it's a long-term thing. So yeah, just something to understand and be aware of as well. So here are my insurance tips to do a bit of a summary for you. Make sure you have the right type of cover. So there are a variety of types of covers: income protection, just total permanent disablement cover, which is short for TPD, and life cover is usually bundled up, pretty much very low cost to bundle it all together. And then there's also trauma cover as well. Check the amounts. That's the issue, that often people don't have like the right levels that they would need. You know, decide how it's structured, level or stepped. Make sure you're getting good value. Different super providers have different value, different quality. And then, of course, this can be complex, so seek professional advice as well to get it right as well. So now changing topic as well, Step 7, got to talk about debt now as well. So debt is something that is, affects all of us over our life, but we can be smart with debt and how we approach debt. Debt is great for leverage, being able to buy a property and assets and investing, and you can also consolidate debts as well. So if you do have a home loan now or into the future, and you do have, due to some reasons, you've had a credit card blowout or you've got car loans, speak to a lender like a mortgage broker or your bank. See if it's right for you to consolidate them in, because you can move expensive debt to lower debt. And even if you don't have a home loan, but you have, say, different debts and credit cards, again, speak to your bank to see if they will allow to waive interest or do a balance transfer as well. These are just things to consider that will help you get out of debt faster as well. Because again, you want to look at bringing down interest rates as low as you can, where you can as well. So again, with lending, it's really important for me to mention that we are at the bank's mercy. The banks decide who will receive their lending money or not, and they're very risk averse these days as well. So just good habits for now and into the future is to be organized with your paperwork. Set up folders on your computer or under your email and keep things such as your tax returns and your pay slips. Things like that. Be organised with your paperwork. Make sure you pay off your most expensive debt first. So when you pay down debt, always look at the interest rates and pay the most expensive one off first, because that'll save you more money. It just makes sense, right? Pay the most expensive one first. And then over time, banks in general want to see that you are moving forward. They want to see a consistent savings pattern, and they don't want to see money going on credit, and they want to see that you're reducing your credit cards over time as well. And even though it's easy to do, especially if you move house, but make sure that you don't pay any bills or credit cards late on time. It goes back through your credit rating, it gets lodged. Banks don't like that at all. So make sure that you always keep your address up to date and you're on top of things like that, because it doesn't seem like a big deal, but very much, we have to put our best foot forward in the future. If you're looking to get any investment property, refinance your home loan, get your first home, they're very, very risk averse, the banks. So they've got to make sure that people are going to be compliant and pay off their loans and not get into trouble. So this then brings me to the final step, which is step 8, which is to get your dream team. So depending on the complexity of your situation, if you do have a home loan, definitely get a good mortgage broker on your side. More and more people are using mortgage brokers than just going to the bank. And I personally have seen a better outcome in that case as well, with just the relationship, how people's loans are structured as well. So get a good mortgage broker on your side. And if you don't have one, over my career, I definitely have a really good bunch, and I would recommend who would be the right fit for you as well. So I'd always be happy to pass on names as well. A tax agent. So if you're in an industry or in a situation where you're traveling and you've got deductions, get your tax done by a tax agent. They'll save you more than what the fee is. It's not very much. And then of course an advisor. An advisor can also help just to get the right foundation and just set things up for you initially so that you get those really good results. So that's really about getting your dream team here. That's really good thing to do, because again, we specialize in just what we do. So that allows you then to specialize in what you do best and focus all your energy into that, rather than having to learn all of the professions to make sure you're doing everything right. This is the easiest way as well. Even myself, even though I know a lot about tax and loans, I still constantly call my mortgage broker and my accountant to ask them things as well. And that's really important. So now I'll just kind of wrap up all of the 8 steps and the impact of getting a good financial setup in the long term. We were talking about things that have really long time frames, and that's why it's important to start early. So these are just some of the numbers with a typical client like Sabrina. So growing her investment portfolio. So from that previous slide, just a simple example of setting up an investment, put her hundreds of thousands ahead over the long term. Fixing up her super so it was structured to have a higher growth allocation is going to be really impactful for her. How we structured her insurance in her case. Again, lots of savings there. And then she did speak to my mortgage broker, who was able to get a better rate, and then over the long term, that would add up to significant savings. Not to mention the fact about how she feels now as well, and the confidence and the ability to not worry and actually think about things that are more important to her as well. So again, the benefits of having organised finances it is really, really empowering. I hear this feedback a lot from a lot of people. Some of my clients go on to do really cool things that they didn't have the confidence to do before. So of course, naturally, the dollar value, which is the increased wealth, which creates more choices in life, having a plan to stick to and avoiding making mistakes as well, and then having more clarity and peace of mind, which then allows you to focus on other areas, as well as having a team to bounce ideas off and decisions as well. So that's really important. And again, even though part of what I love about this is not just the dollar value, it's about the impact that I can bring to people and empower them with their finances and empower their life as well. Because most people, they do want to have a higher purpose, right? To help family, help the community. So that's really why I like this profession. That's what I want clients to get out of it as well. And these are common things that people tell me they want to do as well. So it's always a balancing act with finance. People want to have fun today and enjoy what they're earning today, but also plan for the future. So it is possible to do both. It definitely is. Security, the sense of security that comes with knowing you've got an emergency fund is huge. The freedom and choices that you can have for having savings. People want guidance as well to know they're on the right track. That's why having a good team around you is important. And then the knowledge that you're maximizing your opportunities is such a good feeling as well. So time is on your side. Everyone's at this level that we've got a good opportunity now with lower prices, shares and things like that. There are opportunities. It's really the right time to use the next few months, put a plan in place, even over Christmas, in downtime, to really think about what you're going to do. Because from that slide, the word plan, it is really important to stay focused. Otherwise, people can go off track. So put together a plan as well. So just talking about financial advice, this is, my profession. Everybody can benefit from financial advice, and that's how I set up my company to be affordable and benefit more people. So you don't have to be wealthy to benefit. A lot of clients that I meet, they have credit card debt. They have a negative balance sheet of work, but we work and we have results and we move that into a positive. Any advice fee can be paid via super. Depending on the advice we do. So that's an option as well. You can do it at very little pocket cost. Good advice pays for itself like multiple times, because the impact of each strategy is so strong, especially because time is on our side. And I've made it my mission to make things simple and easy as well, as much as possible. And it helps, and I really enjoy it. So just a bit about me and how I work. So, the first thing I would do is just welcome any, questions and things as well. So have a free chat with somebody. If I'm not the right person to help, of course, I'd introduce you to someone that is the right person to help if it's more of a different type of question. But if I'm the right person to help, then what we would do is set up a free initial meeting via Zoom, that we can dive further into it. And if I can see that there's a lot of value that I can add to your situation, then I would basically, let you know the approximate fee to continue, and then I put together a plan and implement the plan for you. And over time, as you need, touch base and welcome questions and keep the plan on track. So that's a bit about how I work. I work via Zoom. I've got clients around Australia and do after hours as well, so I can be pretty flexible. And you'll find that most advisors will offer a similar type of structure. Some do charge for an initial meeting, but others, like myself, happy to have that chat and help people as well. So yeah, that brings me to the end of the summary. So I'll hand over now to Claire as well. And
thank you so much. Just to start off, I think we can all give Tamara a big round of applause now. I know I took a lot away from that. I hope that you will have a little bit more clarity around your finances and money. And to give you a little bit more clarity as well, we're opening the floor up to questions. So if you are online, please do submit your questions via the webinar panel. We will get to them. We'll open to the floor first for any questions in real life for our mentees. But selfishly as well, I would like to ask a question first, just to start us off. So apologies, guys. You mentioned around super that it has a 15% interest, I believe.
tax rate.
Tax rate, yeah, because you can also do like voluntary contributions to your super. How do you rate the benefit of like an investment versus a voluntary super contribution? And how do you start thinking about planning to contribute to your super? Is it something that we should be doing, or should we be looking into investing first?
Great question. Okay, so there's lots of things to think about. The thing about if you put money into superannuation, first of all, you can't access that money until you're 60. It's very rare that the government allowed this COVID that you can get the money out. So it's very, very hard. So if you put $100 into super, you've got to kiss that goodbye until you're 60. So you've got to make sure you've got a good foundation first, right? Yeah. You wouldn't do it if you've got, say, credit card debt, or if you've got other goals that you really need to reach. So that's what you've got to consider. It's a long time frame. So most of the, in general, again, it's general info here. I don't know all your stats, all the details, but generally, we look at the most urgent goals to do first, right? And even if you want to start contributing extra super even a bit later on, kick some urgent goals first. I did that for myself. I kicked some much bigger goals first, and then lately can make up for it with larger contributions. I'm mid-30s, so I've been through all that in the home purchase, paying down things like that. So another thing is, okay, the question is, do you want to do after tax or pre-tax? So, if you put money into super, you can put in, you can have up to $25,000 a year that you get a tax deduction on, but they include what your employer's paid in. So you wouldn't have the full gap of the $25,000. So you'd really think, well, why do after tax contribution if you can get a tax deduction going in? We'd really have to weigh up what's the benefit of that. Personally, when I pay into my super, I want to get a tax deduction on the money. So we'd really have to weigh that up. And the question is, first of all, do you need to? So some clients I meet, depending on their job and their income and their super, I'll meet them and I'll see their super's X amount. I'll forecast it out and say that should give you a pretty healthy retirement. This will give you 60 grand a year. So do you want more than that? So we've got to have a reason why you're adding money to super, because our generation is the first generation that's actually going to have super paid in for us most of our working lives, assuming you are an employee. If you're self-employed, you're going to have to make those contributions yourself because no one else will do it for you. I have to make contributions myself every year to keep building that, and I want the tax deductions as well. So that's really the thing. It's got to have a reason. If the super's not on track, then we will do that. But again, it's got to be the right timing.
So thank you for that.
Yeah,
awesome answer.
Okay, cool.
Amazing. Well, I'll now open up to the floor. If anyone does have any questions, please raise your hand, and remember to speak nice and loudly for those watching on at home. Yeah. Awesome, Ben.
My question is about investing.
Yes.
What are your thoughts on micro investing? So the context of that is that I feel like I haven't done enough research in investing, that I'm not confident enough that I'm going to take on the risk yet. So I wanted to dip my toes into micro investing first to give that a go, kind of get used to that platform and then start. What's your thoughts on
Absolutely, absolutely.
Is it a good choice?
Yeah, just getting started, dipping your toe in the water investing. You can start an investment with $1,000. You can start with less, but I find the better quality ones start with $1,000. So start with 1,000. You don't have to add any extra money in, but if you want to, you can add in, you can pay whatever in you like, and you will learn a lot from doing that. That's a great experience. I myself will open up a few different super funds and managed funds just to see their user interface and just to learn as well. So yeah, no, definitely. I just want you people to get started. That's a great idea. So sorry, to repeat the question was about micro investing, meaning investing really, really small amounts just to get started. That's micro investing. So yeah, definitely. You'll learn so much through it that it'll be a great experience as well. So just, when investing, you've got to make sure you understand what you're investing in though. When you invest, there's always a booklet called a product disclosure statement, PDS we call it in finance. So read the PDS. That's like a textbook. That's like, going to uni and reading a textbook as well. They'll talk about the fees they charge. Look at the past performance. But yeah, if you're in a position that you can afford to invest, then that's why not as well. Just understand it. Yeah.
Hi. Is there, just talking about paying off credit card debt?
Yeah.
Back at the beginning of the steps, is there a healthy way to maintain one? The context with that is my fiance and I got one because he's really obsessed with accumulating points.
Yes, yeah.
Travel. because you talk about paying it off and sort of getting rid of it, which I'm happy to do that. But like, is there a way that you can maintain it, or like, is there ever a need for them? Obviously,
Yeah. I mean,
financially stable.
yeah, they're a tool, right?
Mm.
They allow you to not worry as much if you travel and put something on the credit card and things like that. It's not really your own money. Of course, they can be used responsibly. So yeah, the responsible way to use a credit card, you can use it, spend on it, then have a direct debit automatically that whatever is owing will automatically come out of your bank account. You don't even have to think about it. But if you leave it to you to check the statement, pay it off, and then you miss a few months, that can snowball and then it starts to get expensive. So by all means, you can keep a credit card. It's nice as a little, again, emergency thing as well. Keep it. You don't have to have a huge limit either, just a limit that's, you know, makes sense for you. Use it, pay it off at the end of each month as well, and then that would look, that's a sensible way to do it, and to use it as a tool. Get your points, check the fees though as well, make sure that the annual fee is not more than the value of the points. So yeah, definitely, it has a place in people's finances. And you know what as well, just expanding on that topic, if you have a home loan, sometimes a mortgage broker will talk about this with you because again, it's a lending thing, but there's a strategy that you could spend on the credit card, use the bank's money and keep your own money, you know, sitting on your offset account. That's a whole nother strategy that you can use credit cards, you know, in a sustainable and sensible way. But you've got to know your own, you know, if people have weaknesses, then you've got to, you know, bring down that limit. But it's a great get out of jail card to have one for sure. So yeah, definitely.
Yeah. Amazing. We might jump to some from the webinar. If you guys do have a question in real life, just raise your hand and we'll get to you as well. So the first one's about super. Yes. Someone's asked about what they should look for when they're looking for a super fund.
Yeah.
What are the red flags that they should look out for as well?
Well, yeah, this is such a huge topic. Wow, I could talk for an hour on this. So every super fund will offer a balanced option. For some super funds, the balanced option has 90% growth. For others, it can have 65. So you know, have a look at that. There's no standard terminology. So look for, you know, the options that they have. Look for low fees. Look for liquidity. You know, during the Royal Commission, when everybody was, sorry, not Royal Commission, the COVID, right? The government allowed people to take 10,000 out. Some of the super funds had liquidity issues. Some got into trouble. So again, look for liquidity. Look for diversification, good returns, and really those are the key. And yeah, those are the keys as well. There's a whole topic about active management, passive management. I'll put that in my ebook as well. So it's okay to pay fees if you're getting good returns for that. I don't think that fees are the end all and the be all really. So just that you're getting good value out of it and it's serving you, that you understand it. Yeah.
Awesome. Another question's come through. Firstly, great presentation. Another question is, do you recommend making extra payments towards your HECS debt?
Okay, so it would depend on what somebody's goals are. Every decision you make with your finance has an opportunity cost. What other thing could I be doing with that money? So I remember, you know, I had a HECS debt and I looked at the interest rate and it was inflation, right? There wasn't much of an interest rate. And I think even now, there's not that much of an interest rate. So me personally, at the time, like I got a home loan when I got out of uni. So I thought, well, hang on, my home loan's 5%, my HECS debt's 3%, I'm gonna pay more money off my home loan. So you've got to look at what other opportunity costs, what you could be doing. So one way to approach it is, if you're just putting all your money on the HECS debt, what opportunities have you been missing for growth, right? What could have you done? Could you have bought a house real cheap and now that's worth more? And if you're comfortable just to plug away at the HECS debt, then that's another way. It really depends on how much it's worrying you as well. Like some people I meet, they're like, don't even think about it. I personally didn't even think about it. I just looked at things that I could control. And again, I had a home loan, which was not as cheap as they are now, it was 6%. And I'm glad I took that road. So I wouldn't be surprised. A lot of people are taking the road of, we'll just pay off the HECS gradually. It's cheap interest rate, let's do other things. But again, it's really up to you and what your preference is and your risk profile as well and how you feel, because you've got to be able to sleep at night as well. But I don't think HECS debt's going to be a big issue to have. I certainly wasn't worried myself.
Awesome. Yeah. Another one online. Can you tell us about ETFs? I don't actually know what that stands for, so please tell me what that acronym means as well. Where do you start and how are they different to shares?
So an ETF is, this again is quite, I probably won't be able to go into this in as much detail, but I will, provide more because this is a really huge thing. I can talk about it, how it changes from say a managed fund. So with an ETF, it's something that you buy online, like say through ComSec or share trading account. So it's like you're buying a share that then holds all the other top shares. So you've got to watch out for brokerage. If you're constantly putting money in, every time you'll have brokerage. And are they actively managed? Like who's that parcel of shares in an ETF? So an ETF holds a parcel of shares. Is anybody managing them? Is anyone buying and selling, or is it passive? So they have a place in financial management, but to be diversified with other investment vehicles. That's my opinion, that it can't just, you can blend it with some passive management, active management. Just be aware of brokerage costs, because if you're going to be trying to buy them regularly, you're always going to be paying brokerage. So for people that may not know, brokerage is a little fee that you have to pay if you buy direct shares. ComSec will charge $10 every time you buy one. That can limit diversification. So you've got ETFs. You can build super funds that have ETFs, managed funds that have a part of it, but it's also good to diversify, I believe, with some active management as well. So it can have its place for sure. Just be aware of those types of costs and understand it. But yeah, sure, it's again, as long as you're getting started and you're building it up via that way, they can definitely have their place for sure. And is it an Australian ETF or does it hold international? Because to diversify, you've got to consider both as well. So that's the thing. What's it invested in?
Interesting. And on the same topic, can you give any examples of managed funds that you can manage yourself, either on an app or online?
Yeah, sure. So there's a type of there is an app. It's called Raiz, RAIZ.com. Again, you've got to, this is just me letting you know what's around. It's not personal advice. It's just general information. They do allow you to start cheaply, put money in cheaply. They allow you to choose different managed funds based on your tolerance to risk, your time frame for investing. You'll learn a lot by going through that process as well. So that's one off the top of my head that I have played around with and didn't see any real issues with. But again, that was a couple of years ago. So check the product disclosure statements and work through that as well.
Awesome. I'll open up to see if anyone in the room has any last questions before we do wrap.
Okay, one last question. What's a good time to see a financial planner? I think a lot of us have questions around, like, do we have to wait for a promotion? Do we have to wait for a windfall of money? Or, what's a good time?
Yeah, that's a great question. So I do naturally meet people that are in a life transition because then they have more questions. But just generally, like, if I just look at my clients who I met more recently, one of them just saw their parents retiring with not enough, and that was enough to motivate them. Another one saw somebody that got ill and didn't have the right cover. And another one was just someone that was stuck and didn't know where to do it and didn't want to do it themselves and saw the value in getting advice. There is value in getting advice. So for those people that naturally like to delegate and you want to know that it's done properly, then that's enough. And again, it's better to do something rather than to do nothing. So you don't have to, Lynn, be at this stage where you've just got a promotion or you've just got an inheritance. It's literally just enough to be like, okay, that's enough. I want to reach out, at least have a chat and see what we can do. Because again, I have a legal and ethical duty as well, but I only take on clients that I can help, that I can add value to. It's actually written in the law as an advisor, I've got to add value. So again, it's just, you can just have a chat if you're not sure I can help with that decision. But again, because a lot of things like super are long term, if you've got super, I'd say it would be a good reason. If you look at your statement and see there are issues with it and you don't want to take it to chance, then that's a good time. So pretty much any time is a good time.
Yeah, thank you.
Thanks for that.
Yeah. We've got one last one
on the
webinar. So it's just around savings, specifically for freelancers and sole traders. So for people that don't have a stable salary, how do you recommend they start budgeting and saving?
Yeah, so I mean, the budget, first of all, can just list out your essential costs of living, right? So anybody can do that, because if you're earning money or not, your bills are still going to keep going in. coming in. So the budget, definitely still put in a budget, still understand your cost of living, but you've got to be a bit leaner then with your cost of living. You may not be able to have all the little extras until your income becomes more stable, and that will happen, right? If you're motivated and then you're building it. So one of that, do the budget. With savings, you just more so need an emergency fund. You really need to build that for the times that then you don't have income. And I've been there before. Like as I said, I opened my own company and I had to have decent savings before I could even do that. I started from scratch. So yeah, definitely that's even a key. If for those people that are wanting to start doing more gigs and freelancing and contracting, even more reason to build up a nice safety net, because that's really the only key, is to, again, follow the steps. Pay off any debt because that will help you save. Keep, emergency funds available, know your expenses, and in times of lower income, you'll just have to then use your savings and tighten things up. And when you do have good income months and you're really working, just be aware that, that's not all your money to then just go and spend because it's, coming in. You've got to keep that and average it out over the year. So that's really the best tip. It happens with a lot of people who are self-employed. Yeah, you just get used to it, and as long as you've got your emergency fund and you know the money will come and things like that.
Awesome. I think we have one burning question.
Oh, yeah. Mine is about HECS, jumping back into that.
Oh yeah, HECS, yeah.
I'm fortunate that it's the only debt I have, and I'm in the mindset that leave it, I'll keep working. But I do compulsively check it.
Yeah.
I do cry a little bit about the index rate that keeps jumping up. Do you recommend to use your tax return to just pay off that index jump that it's on? For example, since I've left uni, it's jumped up $4 grand, which to me is a lot.
I don't want to check mine.
Yeah, don't check it. But do you recommend paying that kind of just that index for with your tax return, or just let it fall?
It depends. It really depends what your goals are. Are you saving for something really big? Because everybody's so different. So if you're in a couple and you're both building up a deposit for a home and you're nearly there, then you're going to think twice about that, right? Because that will just delay that. So your decision to do that, you've got to think, what's it affecting? But if that's not in your case, I might need to just get a bit more context. But if you really don't have any immediate goals or needs or any other expensive debt, then I don't see why not. Then it is going to a good cause, but you just got to be aware it's at an opportunity cost of something else. Yeah, that's pretty much it.
Thank you.
Yeah, you're welcome.
Amazing. We'll put another round of applause.
Thank you.
Everyone who's watching from home and to our in real life attendees as well. Let's squeeze through and have another slide. Awesome. I wanted to give a shout out to Alpha Digital, who has hosted us tonight and partnered with us for this workshop and the whole workshop series as well. So as we mentioned, this is a series. Please do keep your eyes peeled for our next workshop. We're getting the date locked in for the next couple of weeks, so you'll see something pop up on our socials very soon. Thank you again to Tamara. The time and effort that you put in today has been incredible. So we do really appreciate it. If anyone does have any further questions for Tamara, please do reach out to her. So we'll send an email with her details. You can book in that complimentary session, or even swing her an email, or even a message on Facebook to ask the questions that potentially you might not have gotten to today. So again, thank you so much for tuning in. Thank you to the Assisterhood squad as well. We couldn't have done it without them. So I hope everyone has a lovely night. And this is the signal that you've been waiting for to get your finances in order. So go and do budgeting, go and do new investments, and go and look at your debt. So have a great night, guys, and thank you so much.
Well, I can start speaking anyway, guys. Guys, for those of you here tonight, thank you so much for coming along. We really appreciate it. We've learned at least one thing from this evening, and